Well, overall, speaking to a few traders in Kenya, the market seems to be happy with the numbers out of Athi River Mining. They were released after the bell on Friday, pre-tax profits coming in 34% ahead of the previous year, and the dividend maintained at 1 shilling 25. We've got the share price sitting at around about 105 shillings at the moment, with traders seeing 100 shillings as key support, and the share price actually targeting the 122 to 125 mark. I was chatting to Ali Khan Sachu of Rich Management earlier this morning, and he emphasized though that this is a stock not for the flippers. It holds a long-term investment potential, and he recommends a hold for 3 to 5 years. We'll recap on Ali Khan's commentary in a bit. Before we do, joining us now to unpack the numbers is the company's Deputy CEO, Surendra Bhatia. Surendra, thanks so much for joining us this afternoon. Well, despite the positive numbers released on Friday, I mean, it has been a tough year for the company. Higher input costs, high inflation, the political environment, just some of the factors you've had to contend with. Just how much pressure has the business been under over the past year, and what impact has it had on your operations?
Well, you're absolutely correct. The last year was not the easiest of the years. To begin with, we had the global recession. Didn't have much impact in Kenya, but of course the fear factor was there. The wait and watch factor was there in the market. The markets were tight, credit was tight, and therefore the new projects were kind of slowing up. Also, the power costs have been going up in the last quarter. We have got energy costs going up. The political instability had its own little role to play. But overall, I think we focused on our businesses, we focused on getting our fundamentals correct, we focused on getting our capacities running to capacity, we focused on delivering value to the customers, and that's what has helped us to go through the year 2009, running on capacity and improving on our previous performance.
So tough year, but surfacing pretty well at the end of it all. In terms of market share, what position has this left the company in, and what are you doing to actually increase your slice of the pie?
You see, we are essentially in 5 different businesses. Our cement is our single largest business, where we are the smallest manufacturer in the country, and we have close to 10% market share. 2009, we were investing in doubling our capacity, which would give us the base to double our market share. This plant is up and is going to be commissioned by the end of April. We should be up and running in commercial production terms by the second half of this year, and that will give us the capacity to increase our market share. At the present moment in the cement division, whatever capacity we have, we are operating to full capacity and servicing the market. The other businesses, the non-cement businesses, we are market leaders with about 70% market share in each of those businesses. We produce products to international cost and quality benchmarks. We are exporting to about 18 countries. We are operating to capacity. So going forward in 2010, we would probably maintain our market share in the non-cement business, but definitely increase our market share in the cement business.
As I was saying earlier, I mean, many analysts are very positive in terms of outlook for the company, especially in light of the investments you've made in boosting your production capacity to cater to what is very high demand in the market right now. In this drive, though, the company has become highly leveraged and appears to be consistently engaged in debt raising as well. There's concern out there that the company could be possibly taking on too much. Your response to that?
Yes, cement is a capital intensive business, and it's a long-term business. We have to invest the capital up front, and we get the returns over the next 25 to 40 years. The company has therefore little choice but to invest in new capacity. Now, what does it mean? Yes, our borrowings will go up. Yes, our leverage ratios will go up. But if you compare our ratios with any other cement company, locally or globally, during their growth stages, our ratios are very, very favorable. In absolute terms, it may seem that we have taken a lot of debt, but if you take it relative to the other companies when they were in their growth stage, you will find us to be very, very competitive. Now, we put up cement capacity at about $100 per ton of installed capacity, which is significantly lower than international cost benchmarks. That gives us the competitive edge as we go forward.
Are there plans, though, to reduce those debt levels? And if so, when's the company expected to be debt-free?
We in Kenya are completing our investments in the cement side this year. Going forward, Kenya would only be repaying the debts. In the next 5 years, we expect the Kenyan operations to be debt-free. Tanzanian operations have just started. The project would be completed next year and in early 2012. we will be going on the debt repayment schedule after that. Tanzania, we can say about 5 years after 2012, we will be debt-free, but Kenya should be debt-free by 2015.
Well, we talk about the demand that's out there, Surendra, the positioning of the company to actually take advantage of that opportunity that it presents for you. What's your perspective on East Africa's integration plans as it stands right now and what that spells for the company itself moving forward?
I think the borders are disappearing between the 5 East African countries. The market is definitely going to grow. Our market of the 5 East African countries would be as big as probably Egypt or some of the other countries, and going forward we expect that this will help us as a company to open up to a much wider market segment.
So on a solid growth path to actually leveraging off the opportunity, one thing that seems to be nagging at the back of investors' minds, though, is that the cement industry within the East African region has grown significantly. It's become increasingly competitive as well. We've got new entrants coming to the market, and then existing players just like yourselves ramping up production capacity as well. Is there a possibility of a cement glut in the market once all these projects then come on stream?
You see, in the cement industry, the growth is always stepped. The market grows, then you have a lot of people who come into the industry, the market still continues to grow, and then for a little period you have oversupply, and then again you have undersupply because the demand has grown. Now in East Africa, the markets have been growing on an average of 14% over the last 10 years. Now this has led to doubling of the market in the last 5 years. Now, if the market continues to grow double digit, then over the next 5 to 7 years, the market will again double. Now, if the market doubles and if the infrastructure projects come on, the market can double much faster. Now, if the markets double much faster, the new capacity which is being put into place would just be sufficient to balance the market demand and supply situation. Now, we have done a very careful analysis of all the market segments and all the new capacities which are coming in. Remember, all the new capacities which are coming in are not clinker capacities. Significant amount of the new capacities which are coming up are grinding units, which would have to depend on clinker. We are putting up a clinker plant. We are expanding our clinker capacity. Therefore, we would be in a position not only to supply the market with cement, we would be in a position to supply it with clinker also.
Yep, of course, a positive attribute to the company has been its diversification strategy. You highlighted it earlier that you already dominate market share in your other 4 divisions. The latest results showing that you boast sales across all divisions as well. Does your diversification strategy reflect the core business attitude of the company, or is it simply to shore up the bottom line?
No, we are only in one business. The company was established in 1973. We started as an industrial minerals mining company which processes the industrial minerals into value-added products. Nearly 40 years later, we are in the same business. We still mine industrial minerals and process them into value-added products. All the products which we manufacture, whether it is industrial minerals, sodium silicate, lime or cement, are value-added products on one or the other of the industrial minerals we mine. So it is a very, very definitive core strategy where we are diversifying only in the areas which we know well, that is industrial minerals.